Hello and welcome to another 30-minute Thursday. My name is Amit. It is 2 p.m. in the beautiful Pacific Northwest. We are live on Facebook once again. Hope everyone's doing great. Hope you're safe. Hope you're healthy. Hope you're sane. Very, very important to stay sane in an insane world. And I am working from a different studio right now, and I've got this beautiful ring light behind me here that I'm trying to balance and stabilize the brightness so that I don't look like I'm half in the shadows, and at the same time I'm not blinded. It's lighting is weird, man. Lighting is a different thing, and I give a lot of credit to the people that create lighting for TV and movie sets and things like that. Having done this for several years now, it's always a surprise to me how complicated the lighting solutions are. But here we are live on Facebook, and I hope you guys are doing great. We just keep rolling along here, and we've got more things going on. I'm going to just jump right in and talk about what I put on Facebook earlier this morning to promote what's going on here, to promote the 30-minute Thursday, and hopefully you guys will follow along. Hopefully you won't find it too boring on the one hand, and hopefully you don't find it negative or too negative on the other hand. But there's more and more information coming out right now about kind of where we are in the economy, and this information it's hard to come by because the institutions and agencies that are in charge of putting out these details in the first place they're not always the most forthcoming, let's put it that way. And so when this happens, they put out what would be considered by all intent and purposes bogus numbers, and then they come back and they clarify those numbers. But to find all those details and to get all that information and to research and to scrub it and to polish it and to dig deep, that's a lot of effort. And there's a lot of people working on that stuff. And I find information from sources, from things that I research, from places that I'm going to try to turn this around a little bit, see if I can get a different angle here. Sorry, guys, but it's tricky. It's tricky at best. And so I will tell you that what I've seen recently suggests that the unemployment numbers are really, really, really cooked, and not in a good way, right? So the unemployment or the employment data, as it were, that's the one thing that the Fed has really been putting a lot of emphasis on as something that is a bright spot in this economy, something that should be celebrated, and something that, let's see here, okay, it's something beyond that that is the reason why they continue to raise short-term interest rates, and they continue to go after or to keep this tightening monetary policy, because they're seeing, and I spoke about it last week as well, that until they see more and more unemployment happen, they're thinking that the economy is super strong. And well, lo and behold, it turns out that unemployment is probably worse than we are led to believe. And I'm going to try to share that with you without boring you too much, without overwhelming you with some of these statistics and details and concepts, and at the same time without coming off as too negative. So that's the other effect that I'm trying to have here, because at the end of the day, guys, I'm a very optimistic person, and I think that we're going to get through this. We've gotten through all sorts of boom and bust cycles. This is part of our economy. I'm not thrilled about it, but I'm also aware enough to know that we're not going to change it, at least not in this day and age. Now, maybe future generations will see a different reality, but right now, this is where we are. So to just jump right in, let's talk about where the statistics are. The statistics claim that our unemployment rate is somewhere around 3.6, 3.7%, maybe 3.8%. That is very, very close to quote unquote full employment. And the Fed has been saying time and again that because employment is so robust, they are not going to let off on fighting inflation and raising short-term interest rates and doing these other things, because they want to make sure that inflation is fully contained, and they don't want to see wage-based inflation rear its ugly head and create a double dip on the problem with inflation. So the thing about wages and the thing about low unemployment is that if you are a business owner and you need people to work for you and everybody's got a job, then for you to get another employee, you're going to have to hire that person away from some other position that they're currently filling. And most people are not going to leave a job in hand unless what you're offering them here is significantly better. And usually when we talk about that, significantly better means more pay, right? It means better hours, more pay, better benefits, maybe a signing bonus and things of that nature. So as long as the rate of unemployment is really low and there's not a lot of potential available new employees, and the Fed's way of thinking, that creates a situation and an environment in which people, companies looking for new employees are going to throw a lot of money at them, and that's going to cause or help facilitate more inflation. And if you guys recall, coming out of the pandemic in, let's say, 2021, there was a lot of unfilled jobs out there. And I remember seeing things like, signing bonuses for people to work as clerks at grocery stores. And I have nothing against that kind of job, and nothing negative whatsoever to say about people who fill any job whatsoever. I just don't remember a time prior to 2021 when grocery stores were paying clerks a signing bonus, like here's $5,000 extra or $10,000 extra just to come work for us. Like that's how badly they needed workers. And I remember certain restaurants, even after the restrictions on in-person dining came off, a lot of these restaurants were still doing takeout only because they couldn't get wait staff to come back. I don't know if you guys remember that. I remember these things quite well. And it was a shock to me that this is kind of like the restrictions are off now, but we're not back to normal yet. And so that was happening in the last couple of years. People needed, companies needed employees, and they were willing to pay pretty high prices of hourly rates, of signing bonuses, et cetera, to attract that kind of workforce. And lo and behold, we find ourselves now in a situation where a lot of people just never really came back to the workforce for whatever reason. We called that back then the quiet quitting. I don't know if y'all remember this, but I kind of marinate in all these things. And so I look at that and I do remember that there were people that were looking for other jobs while working at certain jobs, or that were planning on becoming digital nomads and getting their side hustle put together while they're at this other job. And then, eventually just kind of disappearing from the workforce. And what's interesting is we went from quiet quitting to now quiet cutting, where companies are changing hours and changing job descriptions and not promoting people up, but kind of keeping people at a level that's not as robust as it would have been or could have been, or as the employees want it to be. And what that's doing is leading employees to cut their own position, meaning they will quit on their own. And when that happens, when an employee quits, basically, that is not reported to the Bureau of Labor Statistics as a job loss because they quit on their own. They weren't fired or laid off or let go. And so it has a way of impacting the statistics in different ways than one would expect. So that's been going on as well. Well, now we're finding out through a lot of research, and I didn't do this research, by the way, but I am researching for the research. But a lot of these economists and statisticians are digging really deep into the employment numbers. And one of the things that I saw just earlier this week was that first, the employees kind of stopped coming. They stopped working, they stopped showing up, they did what have you. And then the companies themselves basically said, we're just going to eliminate the position altogether. So the workers stopped working, the companies have eliminated those jobs completely from their roster, from what they're looking at HR, whatever it is. And somewhere between 4.5 million and 5.5 million fewer jobs are available in this country. And that basically means that there are a lot fewer positions and a lot fewer people working than the 3.8% unemployment rate would suggest. Further, these statistics, or these statisticians, these economists, are suggesting that if you look at the real unemployment rate, the real rate of jobs that not being there and people not working, we're closer to like 6.3% unemployment rather than 3.8% unemployment. It is a significant shift in the calculus. And I don't know, guys. I mean, honestly, I'm just a mortgage lender. I do the best I can to get as much information possible to, slice and dice the details, to figure out what that looks like, to try to corroborate as much information as I can. But I don't have the unlimited funds and the team to help me research all these things. So I'm working on whatever knowledge I've got and whatever data I can put together and kind of coalesce into some thoughts. But it seems like that would be a little bit more likely than a 3.8% unemployment rate. I just look at what's going on nationwide when I see layoffs being announced, when I see companies shutting down, like Yellow Trucking shutting down, letting people go. Here in the Bellevue area, T-Mobile's letting people go. Facebook and Google and Microsoft, Amazon have let people go. Like, to me personally, anecdotally speaking, it seems a lot more likely that we've got higher rates of unemployment rather than low rates of unemployment. And that's a double-edged sword here, because the Fed has been basing their policy on this low unemployment rate, and saying that when we see higher rates of unemployment, we're going to reevaluate our policy. Well, maybe those higher rates are there, and the BLS, the Bureau of Labor Statistics, has just been basically not presenting that data in the most factual way. And so that will most likely have an impact on what the Fed does going forward, which is a good thing, I think. But when you start to think about an unemployment rate that is 1.5 times, twice as much as what we think it is, that means that there's a lot of people kind of on the edge here, right? There's a lot of people, economically speaking, that are in some degree of stress or duress. And more of that might be coming. There's other things in the economy that are happening right now that are suggesting that we're in less good shape than we would be. And I'll again, at the risk, I'm going to give you a smile here, and I'm going to tell you I'm still an optimist, and we'll get through this as a nation, as individuals, as communities. We will get through whatever. But as a situation, I'm just going to suggest that people are tapped out on their savings, right? The US consumer has never been great at saving a bunch of money. This is kind of like the silent not a ha-ha joke, but just kind of like a joke about America and our spending habits. People we know do not save a lot of money. People in our country do not save a lot of money. So we had a surplus of savings because there's a lot of money flying in from stimulus from COVID, but a lot of that money has already been spent. Most of that money has already been spent. We've got record amounts of debt on credit cards now. So people are basically financing their life and their lifestyle on credit cards. Thanks to the Fed and their interest rate hikes, the interest on unpaid credit card balance is somewhere around 25%. It's mind-boggling that that's even legal in this country. Like you're close to loan sharking at this point, but that's happening. The average car payment in this country is above $700 a month. That to me is really surprising. That's very, very expensive. On top of that, I got student loan debts that are coming off of deferment or deferral or forbearance or whatever it is. And so people are going to have to start making those payments as well. And all of these things are coming all at one time. And that's going to create a ton of pressure on the American consumer. And our economy is 2/3 based on American consumerism. Like we need people to buy stuff in order to keep these companies going and doing what they do. And so all of this stuff is moving in a direction that's not great. And when it happens, it usually goes this way, slowly at first, and then very suddenly. And I don't know where we are in the slowly at first part, but we'll know when it's sudden. If y'all remember what happened in 2008, when Lehman Brothers collapsed, this venerable brokerage house that had been in business for 100+ years. I have a cousin that used to work there. I mean, it was a shock to the entire system. And then once that catalyst happened, a lot of other things just came loose, and it was not a very easy ride down. We're still slowly, but we're getting to that point, in my opinion, where we're going to see things moving a lot quicker and more suddenly. Now, that's again with a smile on my face, and it's a real smile because I do believe in this country and I do believe in our economy in general. But when this does happen, if this does happen, recessions are actually quite good for mortgage interest rates. And that is a weird sort of thing. I never want to see good things happen on the suffering and backs of people that are losing their jobs, that are having a hard time with their bills, that are going through challenges. Like that is not, to me, a great outcome, but it is what I would refer to as a silver lining. And the reason that mortgage interest rates like recessions is because there's no inflation in a recession. Our economy has two modes. It's either expansion or it's recession. That's it. There's no standing still. You either have winter or summer, if you would. And so when we go into a recession, there's no expansion in the economy. There's no inflation in the economy. The rate of inflation, the cost of things comes way, way down. It's going to bring with it its own set of problems. I'm not going to say that this is a good thing. It's like, oh yeah, we should have recessions all the time. No, quite the contrary. It's not a good thing. But when that happens, mortgage interest rates will come way down. They will absolutely come down. And that means that a lot of people who have been waiting to buy a home or who have already bought a home and are just waiting for the refinance opportunity, they're going to get back into this market. And that's a good thing. That's great. The double-edged sword of this is that people are going to have employment insecurity. They're going to worry about their jobs. There's an old joke. It's, again, not a ha-ha joke, but a huh joke. And that is simply this. When your neighbor loses their job, it's a recession. When you lose your job, it's a depression, right? If you're worried about your job, if you're worried about your situation, then you might be less inclined, even if interest rates do come way down, you might be less inclined to buy another home or to buy a new home or to do other things, because you want to make sure that you're in good shape before you start to deploy your savings for a down payment. Like there's a trade-off for everything, and that's coming, guys. I let me take my time. Wow, we've got plenty of time here. So it's, in my opinion, it's coming. I don't know how y'all feel about that. I don't want to be the Pollyanna here that's just telling you rainbows and unicorns. At the same time, I don't want to be the negative Nelly that's telling you like doom and gloom, because I think it's somewhere in between here. But I do believe that there are a lot of things coming our way that statistically, informationally, the reporting has just not been great. And so we're not seeing the full picture. And at some point that picture is going to develop, and then it's going to come as a shock to a lot of us. There are things going on all over that are just unprecedented. And so we'll see sooner than later. If someone had to ask me for timing, I don't know. I mean, we still have some time for this to unravel and unwind, and hopefully we'll avert disaster. But I don't know what that's going to look like either. So I think that a recession is coming if we don't already have one. I think that the recession is going to be very, very good for mortgage interest rates, which is great for those people that have a home that they want to refinance. It's great for those people that are going to have the opportunity to buy a home. Another statistic that I read is that for every 1% of reduction in the mortgage interest rates on the 30-year fixed, you're going to see 5 million more people nationwide coming out of the woodworks to buy a home. So rates come down, competition goes up. That's going to be part of this equation as well. Like I said, it's a double-edged sword. It's not all bad and it's not all good. There's a mix of that. But I do think that we are going into a period where there's going to be more problems that are going to hit us. We're not out of the woods yet. Now, for those of you folks that are thinking, oh my gosh, it's 2008 all over again, I tend to disagree with you on that. I think that whatever happens for people that own a home, if they are faced with job loss, employment insecurity, whatever it is, that doesn't mean that the value of their home just evaporates. That doesn't mean that the equity that they've built in their home is not available to them. They may sell that home if they're not working and they can't refinance and they can't get a home equity line of credit and get some cash out. They may have to sell that home, but they're not going to just walk away from it like people did in 2008. They're not just going to give it back to the bank and, start renting again. They're going to sell it for market value. And we have a bunch more people wanting homes than we have homes. And that means that the price of homes or the value of homes will continue to be strong. And so I think that we're not going to see a repeat of 2008. I don't know what we're going to see next. If I did, then I'd be in a much different place on Wall Street or somewhere else, making gazillions of dollars. But I do believe that we're going to see more of this economic mess unraveling. And as we do, there's going to be an impact. This is just the nature of the cycles of our economy and of the way our labor markets work. The Fed meets on September 20th, so that's in less than 2 weeks. In the meantime, there's going to be another CPI number released for the month of August. So we're going to see how inflation's doing. Right now, this week is a very quiet week with economic data, although there are Fed members that are addressing the media. 6 total Fed people are talking to the media. 4 of those people are voters. Not everybody who is a Fed president or Fed governor or Fed member votes on policy about interest rate hikes or cuts or keeping things even. But of the 6 that are speaking this week to the media, 4 of them make decisions and vote. And that's pretty significant because they're going to be telling us, kind of telegraphing their punches as far as what we can expect in the September meeting. I wish that the Fed had better data to work with. I'm not going to assign motives to the institutions and the people behind those institutions or inside those institutions for why the numbers are the way they are. But I think we're going to find out that it's not as rosy a picture, especially on the employment front, as we've been told. And I think that when that comes up, the Fed's going to have to kind of recalculate and recalibrate their expectations on what to do with monetary policy and how to go about dealing with our economy. Now, bottom line, guys, let me take a look. Yep, we still got time. Bottom line is that inflation in and of itself is a reality of government spending, not the Fed, not your job, not my job, but it's the government. Basically, it's not corporations and it's not employees and it's not any of these things. The government is the only institution that is in charge of how much money is actually out there in the big picture. And all governments, our government, whether it's Republican or Democrat, conservative or liberal, left or right or whatever, it's irrelevant. They've been doing this for as long as I can remember. which is at least 40 plus years that I've been mindful of politics. They've been kicking this problem down the road. They continue to kick this problem down the road. And so that, until they get their arms around that, is going to continue to create problems that the Fed is going to have to find a way to creatively finance their way out of and our way around. And that's kind of where we are to this day. This is one of the main reasons why we have these problems in the first place, systemically and structurally speaking. So that's going to continue, guys. I mean, I know one thing for sure: our government, or every government, no government is going to change. And so they're always going to be looking at these sorts of options of, you know, hey, let's find a way to spend more than we have, because they're governments, they can do that, whereas you and I can't. And that's just going to continue to exacerbate the boom and bust cycles that we seem to go through. And if you guys are at all old enough to remember, we've had quite a few boom and bust cycles over the course of our lives, and we'll continue. But here's the thing: we come out of them, right? We go into them, we come out of them, we find a way to continue to do great things. We find a way to pick up the pieces. We find a way to find opportunities to make whatever silver linings exist in these clouds, and we'll continue to do that. And so right now, there's just going to be more of the same. It's going to go slowly at first, and then very suddenly. I think we're going to come to a moment. I hope I'm wrong, guys. If I'm wrong, I will be the first one to say I was wrong. But I think we're going to come to a moment where we're going to find suddenly things have changed, and it's going to be a bit of a shock to the system. There will be silver linings in that, though. There are always silver linings. And I go back to something I read a long time ago, where the character in Chinese for danger is the exact same character for the word opportunity. That happens as well. And those are two sides of the same coin, if you will. So there will be opportunities, but I think that we've got some really weird stuff coming our way. And I will continue to share that information with you. Having said all that, yes, I've got a few minutes left. Having said all of that, I still think if you are really serious about buying a home, right now is a great time to do that. Get in while you can get a price that you can negotiate, while you can negotiate an inspection for your property, while you can negotiate with the sellers. Buy the home now. We will refinance the interest rate in the coming months or years. There will be an opportunity to refinance. So if you want to avoid the competition, I remember 2021, the interest rates were really low, but my average buyer was paying 15% above asking price just to get the seller's attention. So pick your poison, as they say: either higher interest rates than you'd like, but a reasonable deal on the home, or lower interest rates, which is great, but 20 other buyers throwing crazy money at the seller trying to get their attention. Either way, it's going to be a little bit tricky, but like everything else, we will get through that as well. So with that in mind, I want to thank you guys for spending a little bit of time with me on this Thursday. I know it's a little bit of a harder subject and harder conversation to have. I hope you stay positive, stay safe, stay healthy, stay sane. Come back next week. We'll talk more. And until then, have a great day and a fantastic weekend. Thank you, guys. Bye-bye.